What is profit center performance, and how is it affected by the decision to pursue a variable or absorption costing approach to your inventory on the income statements? So, to start with, what's a profit center? Well, it's going to be any branch, division, segment of a company that has its responsibility is generating profits for the company. Okay, it directly adds to the company's bottom line. It's generally going to have its own P&L, which means it has its own income statement to report the results of its activity. So generally, profits or losses itself are the primary determining factor for the performance of the center. So how is that performance metric, right, profit or losses, affected by whether you record inventory under a variable or absorption approach? Okay, so with that being said, here's what the difference in the two, or what is implicated in the two. First, the objective is to allocate your cost to whatever you produce, right? And that's whether you're going to include those costs as cost of goods sold or within your period expenses as selling, general, and administrative expenses. Okay, so this is going to be the primary differentiating characteristics where those costs or expenses that are incurred in the production process are recorded, okay, as cost of goods sold or selling and general administrative expenses. Now, just as a refresher, types of costs: direct versus indirect. Direct are all material and labor. Indirect, you're looking at fixed and variable overhead expenses, okay? So with that being said, what's the difference between the two? So with absorption costing, when you actually sell the inventory, the entire cost of the inventory is transferred to cost of goods sold. Now, the selling, general, and administrative expenses are period expenses. Okay, so your variable costs, right, are still included in the cost of goods sold. Everything is absorbed in there, okay, if that makes sense. There is no recording of variable expenses in this alternative SG&A account. With variable costing, that is not the case, okay? You're going to record your variable cost of inventory to your cost of goods sold, but your fixed income expenses, your manufacturing and overhead, that is going to be recorded to SG&A. Okay, now why does this matter? Well, to start with, if you're going to report operating profits, right, you're going to subtract revenue, okay, from your cost of goods sold. Well, if you separate out the fixed expenses and put them into this separate SG&A account, it looks as if your gross profits are higher, because once again, your sales revenue minus your cost of goods sold, well, your cost of goods sold with variable costing is going to be lower because part of those expenses, the fixed expenses, are included in SG&A. So whoever's reading the income statements is going to get a different understanding by looking at this. So that's the primary difference, and it should be accounted for when interpreting or understanding the performance of the profit center.